Good afternoon, everyone. My name is Michael Naidrich, and I am the co-CEO of AmeriVet Securities. As always, I have the good pleasure of being joined by my partner, Faranello. Hey, Greg, how are you?
Michael.
All right, Greg, you're all things Fed, rates, liquidity, CFA here. At AmeriVet, we got a lot going on. Let's jump right into it. We had a pause the last time. There's a feeling of a pause again here. Maybe a look at 25 by the end of the year. What are we looking at?
Sure. No, thanks, Mike. Yeah, we're kind of going back and forth. We're calling it pause. It's really skip. Because the Fed is likely to leave another rate increase, we think, on the table. So summary of economic projections quarterly. We had the last one in June, this one now in September. We're going to be watching what the market's going to be watching, whether or not they keep that second increase, 25 basis point increase, in, which we think they will. And in conjunction with that, probably more important is what they indicate in terms of rate cuts. So if you look at the projections from June, they've got 100 basis points in 2024, and then they have the funds rate coming down more, obviously, in 2025, recalibrating things. Higher for longer, restrictive for longer here, real rates, keeping them high for a longer period of time. In our view, they probably should, given the strength that we've seen in the economy, maybe take a little bit of the pricing of those rate cuts out in 2024. So maybe relative to 100, maybe they have 75 basis points. So that's I think what the market's going to be watching, and we're kind of pricing along those lines heading into tomorrow's decision.
Got it. Let me put you on the spot here. I usually do it towards the end, but let me put you on the spot here in a little bit of the middle. The 10 years, I think it's like 4.35 right around now.
Close.
Are we going 4.50 or are we going to 4.0? Which one first, and how long does it take us to get there?
Yeah, good. Very good question. We came close to 4% after the employment number. Boy, we didn't stay there very long, which tells me still hedging needs in the marketplace, still a little bit of an overhang. We've talked about a lot of the non-Fed related things. Certainly higher for longer has helped reprice, I think, the rate structure a little bit more so on the long end than the short end. We don't mind the scenario of 450 first before 4%. We think the market still trades heavy. Some of that right now could be heading into Powell tomorrow, nervousness. I think if you look at the stats into these Fed meetings and then coming out, we could ratchet a little bit the other way. But to me, the market trades heavy. I think we feel like we want to maybe test slightly higher yield levels before we go lower. So I'm in the 450 before 4% camp.
Okay.
Yes.
Thank
you for putting me on the spot.
No, that's okay. Hey, we're not done with you yet there. So, has the rates done its job, like with the raising of the rates? What effect has it had on the economy? What is the full impact in your opinion?
Yeah, so it's mixed, right? It's with long and variable legs. My view is, yes, certain parts of the economy have clearly been hit. We've seen that, in particular real estate. It's not really trading. It's kind of frozen right now for all intents and purposes, but the affordability factor is being clearly impacted by rates. You go get a car lease now versus 2021, things have gone up. So we see that. But in general, though, I still think there's a whole universe of areas out there that over the next year to 2 years will be impacted by a higher for longer scenario, probably having the Fed recalibrate lower. So my view is we haven't felt the full effects, the lag effects of monetary policy. If you listen to Chair Powell and the Fed, they feel in today's day and age of central bank communication, they get the information out there really, really quick. The markets start repricing, financial conditions tighten. And so they feel, in some cases, studies have shown, okay, well, the 525 or 50 basis points is already through the economy, and we've seen the full effects of that. My view would be probably not.
Okay, I'm going to put you back on the spot again. One thing, not three, not five, one. What's the one thing that keeps Chairman Powell and his pals up at night, or I guess maybe you also? What keeps you up at night?
Yeah, what keeps you up at night? What keeps Powell up at night? I would say for the first time in a long time, and we've written a lot about this, you see the fiscal side versus the monetary side, right? Not to get into a big political conversation, but the reality is if you look at our debt level, just go back to the global financial crisis, which you and I both traded through and managed risk through. You look at the chart on our national debt over time, it's just gone nothing but up, regardless of what administration was in control. And then you look at extraneous events that we can't predict, which warrant fiscal response, which we had in the pandemic. That can always happen again. So it's not really spending for the outcome of growth. It's spending because we need to fill this gap. And then coming out of the pandemic, the political stars aligned where we've had an inordinate amount of spending over the last couple of years. A lot of that money is still trickling through the Inflation Reduction Act, the Infrastructure Act. You look at these things. So if I'm sitting there as the Fed chair, I've raised rates over 500 basis points in a year, the quickest perhaps ever, and I've still got the fiscal side of the equation, which is filtering through the economy and making the Fed's job more difficult. The other thing too is that we're financing all of this debt now at higher interest levels, and not all the inflationary forces are within the control of what we're doing. A lot of these forces, as we know, are external. So to the extent that that keeps pressure on inflation, it keeps the Fed in a position where they have to keep rates higher, we're doing that at higher and higher debt loads. And to me, I think that's what keeps the Fed up now in today's day and age relative to 10 years ago. It certainly keeps me up at night.
Yeah, you know, I was thinking about this, and I think you're the one who, you know, triggered this thought with me. So much of the talk about is 2024, maybe 100 basis point cut, maybe 75 basis point cut, give or take, or maybe pause for longer. And that's pretty much out there, and that's pretty well been sort of telegraphed by a lot of, you know, either analysts or even the Fed itself. What happens if the rates continue to get raised?
If they continue to go up, what if rates continue to go up?
Yeah.
Interesting.
Yeah.
Or what if they just stay on hold maybe for a prolonged period of time? Yeah, look, I mean, the scenario where rates go up and up and up or further from here, not maybe at the speed that they have, we're not priced for that.
Yeah.
Okay, so bottom line, we're just not, no market is priced for that. Credit, equities, and so we have the funds rate peaking between 5.4 and 5.5. It's not inconceivable. That is a scenario that's out there. It's not the likely scenario based on what the Fed is saying, and also based on the data, which, you know, inflation's tempered, employment is tempered.
And they've been very data dependent, so.
They have been very data dependent, for sure, and the markets have embraced that, but what if they stay on hold for an even longer period of time? And look, if you go back in history and you look at the numbers from the last rate hike to when they actually pivoted and started cutting rates, it varies. 5-6 months. But if you look back to 06, 07, that period into the global financial crisis, they stayed on hold for 15 months.
Yeah.
So if July, in fact, was the last rate hike and they followed a similar course of action to that, they could be on hold through
September 2024.
Yeah, most of 2024 into late 2024 in terms of rate cuts. Now keep in mind, there are some very, very smart people who I respect in the marketplace who have access to a lot of information, who had the Fed cutting interest rates in July of this year.
Yeah, this year. Yeah.
I mean, that's just the reality.
I was one of them.
Well, no.
I'm not the smart one, but I was one of them.
Look, I get it, right? I mean, the economy has been sending mixed messages and certainly has performed far better than most people have expected, in fairness.
Yep.
But the reality is, you know, we pushed back on the rate cuts. But we'll see. I mean, someone in our morning meeting this morning said, well, what's going to change the equation? And what's going to change the equation for the Fed is how restrictive they are over time. Restrictive meaning, you know, they sit at 5.5%. As inflation moves around, those real rates adjusted for inflation, they move. So real rates, you know, if you're at 5.5 and inflation is at 2.5, that implies a real rate. If inflation comes down to 2 or 1.5, those real rates are becoming more restrictive over time. That is the dialogue we will hear from the Fed once it's clear that they're done, is how restrictive they are or not, whether or not they recalibrate in 2024 to become less restrictive if inflation cooperates. But if inflation bottoms down here, which it is showing signs of doing, and starts to tick up, that creates a scenario where the Fed could very well be on hold for longer than what the market is pricing right now.
Yeah, interesting. That'll be something. Let's just do a little quick market color here as we, you know, maybe for our last question here. Equity capital markets, it's back. You know, ARM came out, that was a big one. Instacart came out today, priced at 30. I think it was trading as high as 42, maybe trading at 39. It seems like there might be some legs to the equity capital markets, which we haven't seen in literally a year and 3 quarters, which is hard to believe it's that long. Any thoughts there?
So it is good to see. Yeah. It's definitely a good sign. We know the debt capital markets have been fairly robust. We went through that tough period in March, unfortunately February, March with the bank hiccup.
For sure.
The Fed came in, 13.3 programs. Doesn't mean the banks are out of the woods entirely, but certainly the issuance calendar has been very robust. Yeah. Look, I think, and I have said this and I believe this, There is a downside of higher interest rates. We know that. The downside is what the Fed needs to happen to slow the economy down. It hasn't really succeeded fully in doing that. The upside is on the investor side, there's such demand, right? We see it with our clients.
Every day.
They're seeing interest rates that they haven't seen in 5, 10, 15 years. Historically, you go back 20, 30, 40 years, we have room potentially to even move higher. But right now in this window of time, I think issuers have adapted and investors are more than happy to take down this paper. On the equity side, we know 2021 was a great year. 2022 was an adjustment. To see that activity come back, if there is success with these deals, I think in the fourth quarter, and the Fed does go on hold and give the market some stability with a new rate structure, then I think it sets up potentially for a good scenario. I think just people just want to see the Fed stop.
Yeah.
That's it. I mean, they don't necessarily have to lower rates, but just kind of cool it and let's just take it easy here for a little bit.
I think that's right. And you spoke about a lot in there. I think you're right about on the debt side. I mean, investors are loving these yields. They haven't had them in a very long time. I do think the adjustment has happened in the Treasury offices. Historically, these rates are not horrible. They're pretty okay, especially when you go back to 25, 30 years ago. And I think there is a good chance. I mean, the backlog in the equity capital markets is robust. So I think if you get to a point where maybe there's some religion on valuations, I think you can see some companies come out here, and I think they will.
Yeah.
So look, this is a busy time. You and I have been doing this now for, I think 4 years or whatever it may be, which is crazy.
Yeah, over 4.
Which is crazy, but the Fed continues to be in play. And there's nothing in 2024, as much as people might want the Fed to be out of the way, that makes me think all eyes are not going to be on the Fed in 2024, which means you're going to be busy and we're going to have a reason to continue to sit down, and we're going to have a lot of reasons to have you in front of our clients. So if anyone wants to talk to Greg, you know the drill at this point. Reach out to your AmeriVet representative, and Greg will hustle and we'll get him on the phone.
Thanks, Mike.
All right, man.
Always a
Thanks,
pleasure.
man. Pleasure, buddy.